What's up, everyone? It's Caddy with MoneyVest. So, Federal Reserve doing a big flip from their original SEP, so Summary of Economic Projections that came out back in March, has a huge discrepancy compared to the June meeting, which ended yesterday. So, of course, we had the entire FOMC press conference. We had the statement release and the Summary of Economic Projections, which are obviously now showing a very different story. So I'm going to break this down in a nice summarized format. Got all my notes that I'm also going to talk a little bit about and everything that Jerome Powell mentioned in yesterday's press conference. As always, if you enjoyed this video and find it helpful, make sure that you drop a like. I would really appreciate that. And also subscribe to the channel if you haven't already. And again, links to our Discord and Patreon is going to be down below if you're interested in joining us. There's about 4 more spots left with a 51% discount that you can actually lock this pricing in forever, for life, with all the additional features and tools and functionality added for you for free. So link's going to be down below. We'd love to have you on board for a limited time. You can take advantage of this deal. So if you come over to the Federal Reserve's website, if you go over to the March 20th SEP, that's going to be this over here, and we come down, you'll notice that the Federal Reserve played it really nicely. So what they did was they essentially increased their expectations for core PCE. That's one of the most important metrics for the Federal Reserve when it comes to inflation. That's the preferred measure of inflation here from the Federal Reserve. That's the personal consumption expenditure. And on a core basis, when you exclude for food and energy, they increased that target from 2.4 to 2.6% in 2024. So we're halfway through the year, and the Federal Reserve back in March expected that in 2024, core PCE is going to be at 2.6%. Now, despite this upwards revision in the personal consumption expenditure on a core basis from 2.4 to 2.6, so a 20 basis points upward revision, they left interest rates unchanged. They kept them at 4.6%, as you can see over here. This was the December projection, and this was the March projection for the last time the SEB came out. No changes in interest rate expectations. The dot plot, if you come down a little bit, again, showed majority of people expecting for interest rates to be below 4.75 to as much as 5%. So majority was at 4.6. What happened in yesterday's meeting was a huge flip from interest rate standpoint. And this is exactly what we talked about in our previous updates as well, because going into the meeting, what happened was that the Federal Reserve was penciling in for 3 rate cuts. If you come back to the projection materials from back in March, and if you scroll down, you'll notice that the Federal Reserve penciled in 4.6, right? That's the number that we just discussed. Now, if you come over to the CME Fed Watch tool, right? So if you go over to this expectations for interest rates from the market, you'll notice that we are currently at 5.25 and 5.5%. So that's where we're currently sitting, right? So 5.25 and 5.5% is the current interest rates from the Federal Reserve, and they were penciling in for 4.6. How many cuts is that? That's 3 rate cuts. 25, 25, 25. That's 75 basis points total in terms of rate cuts, coming from 5.25 down to 4.6. So the Federal Reserve, in other words, back in March, told us that we are looking for at least 3 rate cuts in 2024. The market, however, was pricing in for 2, only 2 rate cuts, a September cut and a December cut in this year, in 2024. And that was going into yesterday's meeting. So what did the Federal Reserve do? Well, not only did they match the market, they raised the market even further, with now pricing in for not 3, not 2, only 1 interest rate cut. And this number was the huge revision to the upside from 4.6 to as much as 5.1%, and also increasing inflation expectations for the core PCE from 2.6 to as much as 2.8%. Now, this affects everybody. This affects a lot of people. This really does lead us into some repricing risk. And the reason being is because the Federal Reserve is now only expecting for 1 rate cut in 2024. However, there is a bit of a silver lining that I do want to mention, which Jerome Powell also did talk about. So if you come over to interest rates, he just mentioned that eventually we are going to see inflation, come down and sustainably down to our target of 2%. And what that means is that we have just moved the rate cuts further out. It's not like we're doing fewer rate cuts. We are just doing them at a later date. And that is true because this expectation has also gone up, but it's gone up by a smaller degree. So to put things in perspective here, from 4.6 to 5.1%, that's a 50 basis point increase. But 3.9 to 4.1, that's only a 20 basis point increase. So the gap between 2024 and 2025, in terms of interest rates, the amount of cuts has actually increased. So that is, what they actually did. They actually did a very, very interesting thing that originally the rate cuts from 4.6 down to 3.9 was only about a 70 basis point difference, right? 70 basis points, once again, is 3 rate cuts. But now they've increased that gap from 5.1 to 4.1. That's a full 1 percentage point. That's 100 basis points. In other words, 4 rate cuts is what the Federal Reserve is now penciling in for 2025. So that's actually a lot of rate cuts, and that's why the markets have now moved a little bit in terms of their expectations. They're still expecting for one more rate cut in September, and now once again there's a discrepancy between the market's expectations and what the Federal Reserve is telling us. So Fed is telling us 1 rate cut, the market's pricing in for 2, 1 rate cut in September, the other one still pegged for December 2024, and then 2 rate cuts so far in 2025. So 4 total. Whereas the Federal Reserve is penciling in for 5 total by the end of 2025. So it's actually quite an interesting, change of events here, change of expectations, and of course the Federal Reserve and market, once again at crossroads here with respect to how many rate cuts are we going to see. But coming back to Jerome Powell, and what did he say? He basically said that we have actually received very low readings from June to December of 2023. So last year to the last 6 months of 2023, we actually got some very low readings. And for that reason, we're lapping over some readings here and expecting a certain level of CPI readings good, but not great. So really what we have gotten 2024-wise has been good, but not great. And that's why they're lacking that greater confidence that they needed in order to make sense that, okay, inflation is sustainably moving down to that 2% target. And they also mentioned that nobody in their FOMC is committed to really strong decisions. In other words, they're all going to be very, very data dependent. Everyone at the FOMC is going to be very data dependent. And when it comes to federal funds rate, again, he said the same exact thing. It won't be appropriate to reduce rates until we get that greater confidence that inflation is moving closer to their 2% target. And we want to gain that greater confidence to see if inflation is moving sustainably down to their 2% target as well. And they also mentioned that we see today's report as progress. So that's good. So yesterday's CPI report coming in as a little bit of a progress. Now, one more thing I want to mention is that he did talk about how some members update their revisions for interest rates, for inflation expectations, but not all of them do. Most of them don't. So that's exactly what we were talking about. That's another silver lining for the market, is that yesterday's inflation report, which was actually very good and which Jerome Powell also agreed was showing progress, is not accounted for in the SEP by all the members. He mentioned, and I quote, "Not most members update their expectations for interest rates and inflation because of the data that we just received yesterday at 8:30 a.m. in the morning." When it comes to labor market, he continues to say the labor market is coming into better balance and better equilibrium. Still low levels of unemployment, still a long way to go when it comes to unemployment. And again, you still have strong jobs growth, gradual cooling and gradual moving towards a better balance because there's been a lot of supply of jobs, and immigration workers, again, are also contributing to that equilibrium that we're hitting now. And finally, when it comes to long-run expectations for interest rates and inflation, they're still pegged at where the Federal Reserve wants them to be, at under 3% interest rates and just a little bit over 2% for inflation, more specifically core inflation as well. And it is coming down, and we'll continue to see that unwinding process over time. So that's where we are with the Federal Reserve. And, it's been 3 rate cuts originally. Markets were pricing in for 2. Markets are still pricing for 2, and the Federal Reserve just jumped the markets from 3 rate cuts to now only 1 rate cut in 2024. However, now pricing in for 4 rate cuts in 2025, being more aggressive and just getting them pushed out 1 year further. Markets were overall very much unchanged. If you were to take a look at the S&P 500, the NASDAQ from yesterday, we did see again a green day with markets at 1.3%. And pre-market, we're up another 64 basis points on the back of course, Tesla news, the vote getting passed. And again, NASDAQ here pushing higher. SPY is up about 12 basis points. Semiconductors continue to see a new all-time high, up about 1.4% with NVIDIA. Again, a lot of semiconductor stocks pushing higher with VUG also pushing up to over 46 basis points, almost trading at a new all-time high. Of course, Tesla is pushing higher, up over 6.5%, back up to almost 189 on the back of that Tesla vote in favor for the ratification of Elon Musk's pay package of 2018. So that's where we are. A little bit of a flip from the Federal Reserve, and market expectations here also shifting, but nonetheless, markets still very strong, still very green. There are a couple silver linings that I want to mention. Number one, 4 rate cuts now being penciled in for 2025, so that's a good thing. And number two, yes, it is inflation report, which is obviously much better than what many people were expecting, not being accounted for in the SEP. And again, the mortgage buyback and the treasury securities, that roll-off is going to continue as they're going to start unwinding that process of liquidating some of their balance sheet items. And again, they're going to be reinvesting it back into some of these securities. So hope you all enjoyed this video and found it helpful. For me personally, I think this is a little bit of a net positive for the market. But eventually, if and when the rate cuts actually do begin, I think we really have to ask ourselves a simple question. Why is the Federal Reserve cutting rates? You answer this one question, you'll have a much better, much clearer understanding of market direction, because if the Federal Reserve starts cutting interest rates because economic weakness starts showing up and unemployment starts going up, that's not a good sign. That's not a good reason to cut interest rates, because at that point, the markets are already going to be sensing or smelling a recession, and that could lead to a bigger sell-off. If the Federal Reserve is cutting interest rates because we're achieving a soft landing, inflation is coming down, unemployment stable, then that is going to be quantitative easing, and that's actually going to be a very bullish catalyst for the markets to push higher. Either way, I think both of them are going to be bullish events. Rate cuts eventually are going to be bullish for the market. It's just one is going to have some short-term weakness, which is actually going to give us an opportunity to buy. And the second one is just going to keep the markets rallying and ripping higher and higher to new all-time highs. I think that's the only difference that I see in the markets right now. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. Happy investing. I'll see you all in the next video.